The cash flow statement gives details about cash inflows and outflows for the company over a period of time. And as I said earlier, the cash flow statement, just a worksheet beyond the cash line item on the balance sheet. Cash came in and some cash went out over a reporting period. But from where? Was it from the operations of the business, from selling stuff, from building or buying inventory? Well, all that is explained in the first section of the cash flow statement, which is cash flow from operations. Did we invest in some new plants or machinery? Or did we even sell some old plants we didn't need or some machines that we weren't using? That'd be in the second section, which is cash flow from investing. Did we borrow some money, pay off debt, pay a dividend? That would be cash flow from financing. So that's kind of breaking this thing down into the three sections you usually see in the cash flow statement. But to come back to the first section, cash flow from operations, it seems a little weird because it starts with net income. But the idea is that you've already done most of the work for that section if you start with net income and then you reconcile in and out the non-cash items like depreciation, which is an expense on the income statement, but it's not actually cash out. The cash went out when you bought the thing that you're depreciating. So you need to add that amount back in so you can focus on just the cash flows in this state. Same thing with receivables, or the same idea. It was counted in sales on the income statement and it flowed through to net income, but you haven't yet received the cash from the customer. So it takes a little bit of effort to get into the cash flow statement and analyze it, but it's not as bad as it might look. And in fact, there's a great book if you want to learn more about financial statements and especially about the cash flow statement. It's called How to Read a Financial Report by John Tracy. We highly recommend this book, and it's probably on its 20th edition. It's so good. It's a nice and concise book and probably a bit of fun reading on a Saturday evening next to a roaring fire for you. Okay, this diagram shows at a high level how the three financial statements that we just talked about are tied together. So starting with the income statement, net income goes to one of two places. It either leaves the company as dividends to shareholders or it stays in the company as retained earnings on the balance sheet. And net income is also used as the starting point for the calculations in the cash flow statement in the operating cash flow section. Your ending cash on the cash flow statement is entered into the balance sheet, and the balance sheet ties it all together through retained earnings. Again, this tells you the overall financial position and flow of the company over the period that you're describing. And finally, financial analysis is part of telling that story about the company, and it's part of the planning cycle of the business, part of assessing performance and an input into determining where you go from here at the company. Well, that's a quick overview of the key financial statements. We talked about how finance is actually a story being told about the company, and we went through the income statement, the balance sheet, and the cash flow statement. Hope that helped, and thanks a lot for watching.